Good morning. If you haven't gotten your food, please go ahead and do so and have a seat. My name is Nancy Coveny, and I'm the president of the Catholic Foundation of North Georgia, and I'm very delighted to host this special morning's event with you. Our staff have worked hard to ensure an excellent event with our two investment experts. We are grateful that they are giving their time to share their investment expertise with us. I'm also pleased that Del Ross, a board member, and Brent Herrin, the current chair of our board, will highlight the important work of the Catholic Foundation by sharing their experiences with the ministry before introducing our speakers. The Catholic, the Catholic Foundation has recently completed a strategic planning process. One of the most important items we accomplished was the revision of our mission statement, which is helping Catholics with faith-inspired giving and legacy planning while stewarding funds for the long-term sustainability of the Catholic organizations in our community. What I love about this mission statement is that it identifies the multiple constituencies we serve and how we serve them. For Catholics in the Archdiocese, we help them give according to their faith to what they most care about, and we help them plan their own Catholic legacies. For the Catholic organizations in the Archdiocese, we carefully manage, invest, and protect the endowment funds that will support them well into the future. Of course, the mission statement leads to the vision statement, which is fostering a thriving Catholic community with the financial resources to serve and make a difference in the lives of current and future generations. Isn't that a wonderful future to imagine? A thriving community that has what it needs to do the good work that we are all called to do? We are partners to all of these local Catholic entities and work with them to grow their endowment funds through new gifts and bequests and through the excellent stewardship of the funds. Lastly, I want to share our values: giving, stewarding, leading, and serving. Fully fleshed out, they are giving inspired by our Catholic faith, stewarding the gifts entrusted to us, leading with integrity and excellence, and serving our partners with hope for the future. In this, the year declared by Pope Francis as the Jubilee Year of Hope, the Catholic Foundation is doing its part to build hope for the future. As more people are inspired to give to donor-advised funds and endowment funds, which support our parishes, schools, or nonprofits, much more will be granted to support them. Providing our local Catholic organizations with sources of perpetual support is certainly building hope for the future. Now, in order to get back to your offices and homes and end promptly at 10:30, we will not have any organized breaks. The restrooms are to the right of this room. Please feel free to also refresh your coffee, which is, of course, in the other room, and take advantage of the lovely breakfast while we're speaking. Feel free to get up for any of that. CFP credits have been approved for our financial planners. Make sure you sign in at the registration table with your number to be eligible. I am pleased to now introduce Deacon Chris Andronaco, who will lead us in prayer to begin our session. Deacon Chris has been married to Denise for over 46 years. They have 3 sons, and as he describes them, 2 perfect grandchildren. After retiring from a career in commercial property and casualty insurance, he continues to teach insurance and brokerage skills at Amwins Insurance Brokerage of Georgia. Ordained to the diaconate for almost 10 years, Deacon Chris is assigned to the Cathedral of Christ the King. He also serves, and this is quite a big job, about 65 of our retired priests of the Archdiocese as the advocate in the office of senior priests. We've been very pleased to work together with him in serving our senior priests. And so thank you, Deacon Chris, for leading our prayer this morning.
Thank you, Nancy. And before we get started this morning, I'd like to take a moment to pray at least for those who were hurt, killed in the plane crash in Washington, D.C. last night, and also a prayer of thanksgiving for all those first responders who are working in frigid conditions. And we pray in the name of the Father, the Son, the Holy Spirit. Amen. We gather this morning in gratitude for so many gifts. Thank you, Father, for the gift of the Catholic Foundation of North Georgia and this investment forum, which helps us to minister our time, talent, and treasure to the benefit of so many. Send your Holy Spirit to guide and enlighten our hearts. You desire justice for all. Enable us to uphold the rights of others. Do not allow us to be misled by ignorance or corruption or fear or favor. May we be guided by your wisdom, support us in your power, and unite us to yourself in the bond of love. Give us light and strength to know your will, make it our own, and to live it in our lives. We ask this in Christ our Lord. Amen.
Good morning. I'm Del Ross. I'm a member of the Catholic Foundation Board. I grew up about a half mile from here, and every single summer, we were members of Dunwoody Country Club, and I was on the swim team. And my sisters and I would walk here in the morning for practice. We'd stay all day. We had an afternoon practice, and then we'd walk home. And our entire lives, until very recently, we thought that we had to go to both practices. We hated it, but we liked being at the club all day. Found out recently, no, it was optional. My mom just said, just get out of the house. I am happily married for 31 years to a high school friend. We didn't date in high school. In fact, we're the couple that every time we go to reunion, we're coming up on our 40th reunion, all the people come up to me and they're like, how did you end up with her again? And the answer is pretty simple. God loves me. And I know this because he created nearsighted women, and it's just the greatest thing ever. I have 4 kids. Jamie and I have raised 4 kids. All of them have gone through Catholic schools, and I have 1 remaining at Marist High School. The rest have graduated. I've got a bulldog and 2 Kentucky Wildcats. And hopefully I can afford wherever the 4th one wants to go. The thing we've learned about raising kids, especially in today's world, is, well, I've got a pretty strong opinion about what you can hold parents accountable for. I think it's really 2 things. It's manners. If it's a rude kid, it's the parent's fault, right? And compassion, how they engage with other people, how they view other people. And these are both things that not only are about teaching, they're about modeling. So if my kids are ever rude to you, I'm sorry, it's my fault. But compassion's actually a little harder. I wanted to talk about how we use a donor-advised fund to help model compassion for our children. Several years ago, I left an employer where I'd had a deferred compensation plan, which, to my surprise, all came to me shortly after I left the company in a big lump sum. I wasn't expecting it, didn't really particularly need that cash right now, and the only ones truly happy about this was the government, because they were going to get a big check. Well, my financial advisor at the time said, you know, we can help with this. You guys, you give regularly to a lot of causes. You could create a donor-advised fund. And like almost everyone I know, I said, what's that? And she said, well, it's great. You put this money in this fund that is now, you get a 100% deduction for that year for the charitable giving, which is great. It'll help reduce your tax burden for that time period. And now you have this fund from which you can make donations. You recommend donations, and you can support the nonprofits, the charitable organizations of your choice. Well, this sounded great. It was really good. We were able to have this fund, a foundation, if you will, and be able to use that. My dad did the same thing at about the same time, and we had an idea that was something we practice to this day. And I'm also happy to say that my donor-advised fund is with the Catholic Foundation. What we do is every year, throughout the year, we make donations, but at the end of every year, we meet with our children, and we ask them to come forward with organizations that they care about and they support, right? Whether it's Doctors Without Borders. That's what my youngest daughter proposed when she was, I think she was just in 5th grade. The Smasherson Foundation, which is a great organization that supports children with cancer right here in Atlanta. Any number of organizations. They bring them forward and they explain, this is why I care about this organization, why it matters, and why I believe we should support it. And we make a donation. We make a family decision about what organizations we're going to support. And we're modeling that behavior, that active compassion that we think is so in line with our values and, of course, Catholic teachings, where we are taught to care for each other even more than we care for ourselves. That's a powerful thing. And if you haven't explored donor-advised funds, this is a wonderful next step for everybody here today to think about. And by doing it with Catholic Foundation, you'll know that those funds will be managed. They're managed by the firm that I'll be introducing the speaker from in just a moment, and it will be managed in accordance with Catholic teachings. This is really comforting. The money will grow. You get to determine where the funds are dispersed, what organizations that money goes to, and you get the tax benefit. It's a win-win all the way around. Definitely a huge win for our family. And I knew we were doing it right when I heard my youngest, talking to her friends about it. Talking to her friends like, we have a foundation that we support these things, right? I chose the charity this year. That was cool. That made me feel really good. Again, sometimes she's pretty rude, but we got that part right. So now I'd like to talk about our speaker. Michael Butkus is with the Atlanta Consulting Group. The Atlanta Consulting Group has been managing the funds that are entrusted to the Catholic Foundation for, I don't remember how many years now, Nancy, but quite a few years. This past year, despite being wildly happy with their service, we said, we really should just look around. And I wasn't part of the committee that did this. I was just on the board, and we got regular updates. But we cast a very wide net, and we met with a lot. I'm taking credit because it worked out so well. We met with a lot of firms who were really terrific, right? They had the right alignment with values. They had competency. They knew how to manage funds in an appropriate way, according to Catholic teachings, and grow them. And after all that, after a rigorous screening process, we chose the firm we were working with all along, Atlanta Consulting Group, because they are simply the best for us, a great fit, and they've done a fabulous job. So we trust them, the performance is there, and it's a great alignment. And I think you'll see that in the type of person that Michael is. Michael, like me, has multiple kids. He's got 3 kids. He has 3 girls. I have 3 girls. I stuck a boy in the middle of there. And we had a great conversation about that. His children, in fact, are the same ages as my oldest. They're the same age difference. They're just earlier in the cycle, right? He's got, I believe, a 5th grader, a 3rd grader, and a kindergartner, which basically means he's in what I refer to as the vortex, right? And it's amazing that he's here. I believe this is a wonderful thing, because I know usually Thursdays is when my wife and I would have our logistics meeting for the weekend. So this is a real gift for us. Michael, we had a great opportunity to catch up. We actually met at a board meeting a while ago, but we had a chance to catch up just last week. And honestly, I have to say, the only thing I could possibly hold against him is that he went to the wrong school. He went to Westminster. But he can explain why that happened. It's a fabulous institution, really, really good. But otherwise, he passes full check marks all the way around. I think you're going to find his remarks about the challenges and opportunities in the current environment and the approach that the Atlanta Consulting Group takes on behalf of the foundation and for all of their customers quite engaging. And so please, if you could welcome to the dais, Michael.
Thanks, Del. And all the credit goes to my wife, Taylor, because she ran carpool this morning and is actually here. So the vortex was very much in her court this morning. Big picture, when we get going, the idea for those that have come in years past, good news, the talk has changed. I don't have the same cartoon, and we decided to switch it up a little bit this year. When Nancy and I were going through ideas of what do we present, how do we get more people here, which clearly worked, so I guess my talk was getting stale. The idea was when you are someone like Dell or someone that's considering giving to the Catholic Foundation, what happens once you do that? Where do your dollars go? How do they get invested? What's the process? And so the goal today was to go through that process. And so we came up with the title, Faith and Finance, Building the Catholic Foundation Portfolio. But in the interest of being a good Catholic, I have to confess something. Over the last week, the Vatican has come out with some comments on AI. And so I have to confess that I did use ChatGPT to brainstorm the titles for this presentation, and in fact create one of my images. So if there are 3 arms on one of the construction workers or something odd, that's why. But Pope Francis did also come out and say that he's more concerned about human intelligence than AI, and I'll revisit that in a moment. Let's see here. So let's get into things. Before we get into me and the portfolio, I just want to highlight ACG and the team that's behind me. We've been around, it says 35 years, but I just realized it yesterday. We've now been around for 40 years. We were founded in 1985 by a gentleman that snuck in here a few minutes ago and is sitting in the back of the room. We're headquartered here in Atlanta, but have a small office in Lexington, Kentucky, manage approximately $14 billion of assets under advisement with over $3 billion of Catholic assets. We're very proud of the fact that we're 100% employee-owned in an environment where a lot of firms are selling to bigger banks, merging, have private equity money. We've made great efforts to maintain a 100% employee-owned atmosphere. The folks that are in this black and white picture, that's our infrastructure, and I wouldn't be standing here and we wouldn't be able to do what we do for the Catholic Foundation if not for every single person in this picture. Everything we do and everything I talk about today is because of the team that's right here. So what do we do? When we get into portfolio construction, I had to think of a theme today. We love cartoons, but there's no great Catholic portfolio construction cartoon. I looked long and hard. I asked ChatGPT to create it for me. Nothing existed, so I had to think of a theme. And so I went biblical. And so Matthew 7:24 to 27, you can read this on your own, but when Jesus was finishing up his Sermon on the Mount, and I doubt he was thinking about portfolio management when he went through this, but he talked about building a portfolio on a rock, not on sand. And the imagery we're going through here today is thinking about the fact that you may have the time and the storms of the markets, and those storms would be 2020, 2022, and those markets seem very distant from today, right? We had 2023 and 2024, but if you were to take a step back and go look at your 5-year trailing return for any of your portfolios, this portfolio, those include those numbers, right? It doesn't seem that way. Everybody thinks that stocks only go up, right? All these tech stocks only go up. Markets are perfect, but unless you really stood the test of time and built your portfolio on a rock, you probably had some freak out moments. And so when we think about building our portfolio, we think about this foundation and building a house. And so that's the imagery we're going to create today. So who are the architects, engineers, and builders, also known as fiduciaries? Here's my ChatGPT image. Our new chief compliance officer zoomed in here and found some of the interesting parts of this picture, so you can do that on your own. But many of them are in this room. If you look around, there are a lot of checks and balances. A lot of times we live in a world where people ask, who's watching the store? And if you go around, obviously it starts with Nancy, who, okay, she came back. I thought she left for my talk. I was really wondering why she decided to get up. Certainly, she's the be-all and end-all here, but on a day-to-day basis, we have John Ronco. He's often the first to respond when I send out monthly scorecards to ask me questions about what's going on in the portfolio. Sometimes has a little quip. On a quarterly basis, I get to come and report to an investment committee. Many of those people sit in this room today. They do not take it easy on us, especially when things are not going well, but also when things are good. They ask great questions. They challenge us. They go through, why aren't we doing this? They oftentimes sit on other committees. They may ask us about equal weight. Yes, John, I'm looking at you. That committee has folks that report to the board of directors. Donna, who's the chair of that committee, has to go every quarter and report to that board of directors, and annually I get the opportunity to go sit down with them and give a brief talk. So I'm accountable to them as well. We have Truist on this list. Truist is the custodian who holds the assets. We live in a world where everyone wants to know where those assets are held. Who's watching that? Can they be taken away? And then finally, we're at the end of the road, Atlanta Consulting Group. We are also reconciling those assets, making sure everything's there, running performance reporting. And you'll see that at the very end of this report, just making sure that everything's there, sometimes reconciling Truist's numbers, looking at some of the alternative investments, looking at some of the fixed income investments, making sure the performance is what it's supposed to be, and hopefully building a portfolio that is on a rock. Are there any attorneys in the room? Raise your hand, admit it. Okay. Well, this is the exciting part for you all, the investment policy statement. This is the blueprint for your portfolio. Before we do anything, we have to build out this investment policy statement, which is roughly a 20-page document that goes through, and this is where the attorneys get excited. They get to redline this. The only disappointing part is that when they finish, they can't charge anybody for it. And they go through here, and we've been spending probably the last 6 months or so going back through this. I give the committee credit. They did go through a competitive RFP process, and as part of that, they took all the suggestions from that RFP process, and they applied that to this investment policy statement. And so you'll see here, this goes through the purpose of this investment. Each pool has a different purpose. What are the goals and the objectives? What's our return objective? Our return objective isn't going for the moon here. Each pool has a different objective. One of the pools has an income need. So what is the income need for that? We have various managers in this pool. What are the performance relative to those benchmarks? What are the constraints? What are the time horizons? Unlike your personal assets, right, these are perpetual. So that mindset is very different from someone who's trying to retire, right? We're thinking forever for many of these assets. And then finally, in the bottom left, which is what I've spoken to in previous years, is the ESG and socially responsible guidelines within these pools, which we have to set that up. We're always reviewing this. The other component of it is the roles and parties and the communications. That sets up us, how often we have to report. That keeps Truist accountable, but it also sets up for the folks that sit on the committees. This isn't just something you sign up for, you put on your LinkedIn profile, and then you never show up. All right, you have a fiduciary obligation to come to the meetings, to be accountable, to actually participate in the meetings, and this group is great at doing that. I may sit on some other committees, or have in the past, where people don't come, and that's not doing the best for those organizations, and you're not being a fiduciary. And then finally, you get to those asset allocation guidelines in the bottom right. Those are very, very specific, setting up the targets and the guidelines to build a portfolio. That sets up the diversification components and the sub-asset classes to get into our next step. So this gets to the fun part. This is how many rooms you need in your house. It takes those blueprints and you build out the house, how many bedrooms, how many bathrooms. This is where people get really excited. And so when we go through this process, the idea for us is to set up, the pre-experiencing various portfolio conditions. And we go through a pretty complicated, it's a Black Litterman model where we build out our capital market assumptions on an annual basis. We'll be going through this in our next quarterly meeting. We go through all the potential downside scenarios. Ultimately, our goal there is to make our clients feel better and make more well-informed decisions with a higher probability of meeting their long-term goal and their objectives. And if you go across the bottom part of this page here, this is something that we found years ago, and it's still very true, is that if you go back 30 years ago, it was very easy to be on one of these committees. You could put approximately 75% of your portfolio in fixed income, the other quarter in cash. You got a 7.5% return with 6% standard deviation. It's really easy to be on these committees. As you go decade by decade, your portfolio gets increasingly complicated, increasingly risky, but you're getting the same return. And so over time, it's become more difficult to get the same return. Now, we're hoping maybe that gets a little bit easier, but the role of the investment consultant and the committee member has become increasingly complicated. So this asset allocation process has become increasingly important. So what we believe is this process drives the majority of returns, not the managers, not the stock pickers, but how much money you have in stocks versus bonds, large cap versus small cap, international versus domestic. That's going to drive your return. But there's always a reason to renovate, right? There's always a reason to sell your house. Everyone, we could go turn on CNBC right now, someone is talking about something terrible in the world, right? And if you look at this page and you scroll in here, there's a great Peter Lynch quote at the bottom where far more money has been lost by investors preparing for corrections or trying to anticipate those corrections than has been lost in corrections themselves. Every meeting we could get together and say, hey, you know what? I think this is the year. We've had 2 incredible back-to-back years in the S&P 500. So should we sell it all this year? You know, maybe take all of our gains because maybe this is the year there's a correction? Or should we have a 20-year outlook and say, maybe there is a big pullback this year. Maybe it's going to be 2020 again. Maybe it's going to be 2022. But we can live through that because we just had 2 great years. And we have a 20-year outlook. And we look at this page, and things are going to be just fine. So at the end of the day, we model things in 4 big, broad categories. Growth, inflationary, deflationary, diversifiers. You can see the sub-asset classes within those 4 with the idea of building a portfolio that is a mix of all those categories. Within these categories, we're always looking for various Catholic options, not necessarily a Catholic option specifically. The benefit of the world we live in is, believe it or not, it's getting more popular. So if you're looking for things personally, believe it or not, there are more Catholic ETFs now. There are more Catholic mutual funds. And so we're starting to see even more Catholic private equity, Catholic hedge funds. And so within these categories, we're starting to see more options, but we're always modeling this with little tweaks here and there. So the next step is some interior design. This is where people get really excited, myself included. I grew up on the research side of things. I love talking to managers, and it starts with the quantitative process. This is where we get into the numbers. And anyone in this room can go subscribe to Morningstar right now, right? Go spend $300, go to Morningstar.com, sort by 3 or 5 year return, and you can find the best performing manager out there, right? Who's doing the best? The problem with that is there's a lot more to it, right? Everyone looks good on a 3 and 5 year basis right now. The other question you have to ask is, active and passive, right? Which index do you use? And so here are some of the other factors we consider. We obviously look at annualized performance, calendar year performance, rolling 3 and 5 year. But the main questions we ask are those bottom left questions. Are they consistent? And the big question is, especially for active managers, is it repeatable? Right? Can you consistently do this, and can you repeat your performance? We really are concerned with one-hit wonders, right? There's a lot of managers out there that just get lucky, and can you do it year over year? Where we think we add value at the ACG level is on the qualitative side of things, because anyone can pay for that data, right? You can go out and subscribe, but can you get into the granularity of meeting these managers? And in the qualitative focus here, people call these the 4 Ps. Can you go through this and get in this room? Some of these people are in this room today, so thank you for coming. And can you talk to them and say, is it a team or is it one person, right? Is it one rock star and they control the entire process, or is it a group of people? How much experience do they have? Like, we're living in a world where some asset managers are getting older, right? And are they bringing along someone younger to teach them so that when they retire, it's not a huge transition? What's the organizational structure, and what's the alignment of interest, right? How are they paying their people? Are they paying them based on the performance, and is the structure aligned for the whole team? What's the philosophy? This is incredibly important. Is it fundamental or quantitative? We live in a world where almost everything's quantitative now, right? And that's totally fine, but do we understand it? And can we explain that to our clients? We have a rule internally where if it's quantitative and we don't understand it and we can't explain it to our clients, we're not going to invest in it. And that's happened. We've learned that lesson the hard way. Style, is it growth or value? A lot of folks said that they were value in recent years, and then we found out that they were cheating, right? All of a sudden, these value managers looked like a growth manager. And so we've had to ask that question, or do they have style drift? When we get into that bottom right section, we get into the process. And this is where the Catholic aspect starts to really become, in the faith-based, is can they manage a portfolio with a Catholic lean? Can they either screen out names, or more so, as if you've heard me in previous years, can they engage? Can they vote proxies? How do they generate their ideas? What's their sell discipline? I wish every portfolio manager was right all the time, but eventually they're wrong, and can they admit that? And so that's a question we often ask folks. When were you wrong? How did you handle that? How do they build their portfolio? That risk management component of how do you manage risk? And then finally, I've said it once and I'll say it again, is the process repeatable and did they get lucky? And then finally, that bottom left section is just a byproduct of all these things. What is their performance? But it's not just about the performance, it's about those risk-adjusted returns. What type of risk are they taking to get that performance? Because a lot of folks take a lot of risk and they get great performance. That doesn't necessarily show up if you just went into Morningstar.com and sorted by 3 years or 5 years. We want to see what kind of standard deviation and all the other statistics you take to get there. So if there's one slide I want everyone to pay attention to, both personally and professionally, it's this one today. Something we've actually experienced with this committee at the Catholic Foundation, and something we've had to go into a lot of our committees with in previous years here is this is where we become behavioral coaches. We call this living through underperformance. So these are just some statistics that we've pulled where we define a high-performing mutual fund as any mutual fund with 10-year outperformance of 1% or greater over their benchmark, right? So you've got to wait 10 years, and you outperform your benchmark by 1% or greater. Does that make sense? So 100%, I can never say 100% ever in my business, but I can here, of those high-performing investment managers underperformed their benchmark by at least 1% over a 12-month period. It's a full year. 97% of those high-performing investment managers underperformed their benchmark by at least 1% over a given 3-year period. And then if you go back to that 1-year period, 99% underperformed by 3%, 95% underperformed by 5%. So the point of that is if you want to outperform over long periods of time, you have to live through underperformance. And so what we've experienced here at the Catholic Foundation at the committee level is having some of these conversations where you have to sit down and say, yes, they're underperforming, but are they underperforming because something changed overnight and these portfolio managers lost their mind? They forgot how to invest? Or did the market shift? Maybe the market's wrong. And what we've found is oftentimes maybe the market's wrong, the market shifted, and we're going to live through some of that underperformance. And all of a sudden, the market is maybe right again, or maybe the portfolio managers didn't lose their mind, and we look great. And so what we've found is over long periods of time, if we're patient, and we think in terms of decades, not days, the performance tends to look great. Now we're back to Catholic Michael. Within this entire process and interwoven in this process is this Catholic investing overlay. So this is what I've talked about in years past. We've got 3 big picture concepts. Laudato Si, less relevant today. The USCCB letter, which is certainly ingrained in our process because it existed prior to Mensurum Bonum. But what I would say I would have everyone here Google and focus on is really that Mensurum Bonum concept at the bottom, because the movement we're seeing both in the Catholic asset management world and for all of my clients is really that good measure in that Mensurum Bonum world. We're starting to see, and we're hoping that if you see all these assets come together in the Catholic world and start voting proxies and engaging these companies, we could see real change. And so where we're starting to see that at the Catholic Foundation level, and something we're really excited about, the very first change we really made here was our S&P 500 fund is invested with State Street. And we're in the Catholic screened S&P 500 fund. You've seen me show the performance of that years past, where it ebbs and flows, but net of all fees, over the last 20 years, it's actually beat the S&P 500. Well, over the last year, we've transitioned. We're voting the proxies with a Catholic tilt. And Nancy and I just looked with over the last week or so, they sent us this huge proxy voting report. We're voting the proxies, and they have a column that shows Catholic voting. And so what you can see is some of the proxy voting is Catholic. And so over time, we're going to see what's Catholic. Interestingly enough, I don't know if you looked through this, some of the proxy voting was related to AI, which I thought was really interesting given all of the news over the last week. So we're starting to see that continue. The other thing we do, just to point it out, is we do have software here on the next page that is related to negative screening. This is something that's always going to be part of our process. We run this, it's built into our investment policy statement. We screen all of our investments with the goal of getting to as close as we can to 100% compliant with the USCCB. The byproduct of everything we do here is at the end of the presentation. We have 3 portfolios. The flagship portfolio is the Catholic Legacy Growth portfolio, which is the most risk-heavy, approximately 75% risk assets with 25% fixed income. The income with growth with income, portfolio, which is much lower in terms of equity exposure. You can see it's only 30% equity exposure. That portfolio has an income goal due to one of the flagship, can I say it? With the Conrad, I never know if I'm allowed to say, it's mostly the Conrad family in there, and so with the income goals of that portfolio, it has an income focus. And then the moderate growth portfolio is primarily charitable gift annuities, and so this portfolio is built around the rules of the National Charitable Gift Annuity rules. The performance on the next few pages here show we've got approximately $122 million in the Catholic Legacy Growth portfolio. You can see the performance. That performance is that dynamic balanced index that is a gross index. Just so everyone knows, all of our performance is net of all fees, managers, ACG, Truist, Catholic Foundation, so it's a net of all fees performance number. You can look through that at your leisure, but I just want to end with this. So I mentioned that the Pope said that he's more concerned with human intelligence than AI. On Monday, Pope Francis reflected on the concept of networking, hearkening back on the biblical imagery of fishermen's nets and Jesus' call to Peter becoming a fisherman of men. He said that responding to Jesus' invitation requires skills, knowledge, and resources to build a network that can provide information that frees people from the sea of despair and disinformation. Let us think of how much we could accomplish together thanks to the new tools of the digital era and to artificial intelligence, if instead of turning technology into an idol, we were more committed to networking. Thank you to everyone here for taking the time to network with us today. Every year I enjoy meeting new people in this room, and hopefully you leave here not only feeling like you've learned something, but also with a desire to go and learn more. With that, I'll open it up to questions. Uh-oh.
Michael, given the current interest rate environment, what are your thoughts about fixed income and where it fits within the portfolio and maybe within, as a broad umbrella, fixed income, and a lot of variations within that. And then also fixed income versus stocks. There's been a lot of volatility in the stock market. Kind of your thoughts about stocks versus fixed income.
Sure. So a couple different ways we approach that. We have multiple portfolios. So for you as a donor, right, if you're thinking about your allocation here, we have, a much more fixed income leaning portfolio versus a much more equity-leaning portfolio, so we have multiple options. And then within the portfolios themselves, we're always actively approaching the various options within them. So even within the Catholic Legacy Growth portfolio more recently, we've made some changes, and we're always adjusting to say, okay, let's look at the duration, let's look at the performance. So each portfolio is addressed in its own vacuum. Each manager is looked at within its own vacuum to address duration, to address risk. And we've had instances where maybe managers are taking too much risk, and we have to look for a different manager. In particular, over the last few years, we've had to live through some volatility, way more volatility than we've ever experienced in really history with fixed income. And in the current environment, we're actually going to be discussing some of that when we assess our asset allocation in our next meeting. So it's a constant ebb and flow with the committee. We have multiple pools that address that in different ways. With the growth with income pool, especially over the last few years, given the rates, this pool has had as low as a income of, I think we got down to 1.5% when rates were super low, and now we're up to maybe closer to 3%. And so we're always adjusting it. We review it quarterly. Internally, we're looking at it on a monthly basis.
Michael, in your assumptions for 2025 and next year, what does ACG think about an environment or a government policy based on tariffs? Are tariffs beneficial or detrimental to the economy?
Great question. I'll point you to, we do have some pieces on our website. If you go to ACG, acgconsulting.com, we did recently put out an insight, more so about international equities, less so about tariffs. That's a big question mark, right? Let's go back to last weekend. We had a big issue with tariffs on Colombia, or did we, right? And so the big question is, and it's in our quarterly commentary, which was also available on our website, is it a negotiation tool, or is it going to be something that is actually involved in our economy and could be quite inflationary? And so, to be honest with you, it's an unknown at this point. We have not significantly changed our international exposure as a reaction to that at this point. So I'd say that that's probably been the biggest no change. I'll defer a little bit more to the gentleman in the back who'll go after me. He's probably going to talk more about that. But in terms of portfolio changes, we have not made a major shift yet due to tariffs.
You're kind of alluding to it, but how often are you actually reviewing the asset allocation?
So we run our capital market assumptions annually, making adjustments. Again, I've alluded to the Black-Letterman model that's run internally. So it's very quantitative in nature. It's not us sitting around a whiteboard deciding what the S&P 500 is going to do each year. We also check that against 39 other firms to make sure that we're in line. And then we go to our clients each year and run that. And so sometimes you'd assume that we'd make an adjustment one way or the other, but in some instances we actually de-risk. So we've come to the Catholic Foundation and said, well, maybe we're taking too much risk in the growth with income portfolio. Maybe we should de-risk. And so we evaluate it each year, but we don't necessarily make changes because of it each year.
You mentioned in your presentation active versus passive. How do you choose?
So it has a lot to do with market efficiencies and or inefficiencies. I mentioned the State Street Catholic Index Fund. So when you see U.S. large cap equity here, in both the Catholic Legacy Growth portfolio and the Growth with Income portfolio, that is 100% passive. We've learned that in a lot of our portfolios, it's very difficult to beat the S&P 500. And so we have the ability to get great beta exposure that's Catholic screened, and we get to vote the proxies, and so we're 100% passive there. Whereas in small cap, we've gone various ways over the years where we have some exposure to active, some exposure to passive. And the big question then becomes, are you active or are you passive just because you're in an index fund? And so what we've found is you can be active in the passive space. What does that mean, Michael? Well, what index you pick. We are active by picking the S&P 600 instead of the Russell 2000. The reason we like the S&P 600 in some instances is because you have to have earnings to be in the S&P 600. Russell 2000 has approximately 40% of the companies don't make money. We think that over longer periods of time, companies that make money will outperform companies that don't. Makes sense. And tend to be less volatile. And so we picked that index over the other. And so sometimes it may be passive, but maybe an active decision to pick a different index. And so that's how we evaluate as we come down our scorecard and get into international markets and less efficient markets. We tend to be more active because we think that that's a stock picker's market. And we tend to be perpetually active in fixed income.
Michael, it's come up several times in the questions and responses, volatility. And the conservative strategy has always been to try to mitigate volatility risk. Is there a way to exploit volatility? Because it seems like the only thing we can really predict is that things are going to be unpredictable. Right? So is there a way to have an investment strategy that takes advantage of this without being wildly risky?
We do have some exposure to hedge funds and alternative investments there. You'll note that in the Catholic Legacy Growth portfolio, it's only 10%, and we've had no shortage of volatility within that bucket. Our living through underperformance may be referencing some of our experience there. We had some volatility in that portfolio coming out of the COVID environment, where that was bad volatility. But more recently, that has been an area of alpha for us. And so what I'll tell you is that in going into this year, we're seeing a lot of managers that are really excited about volatility. When I read, especially if you're a stock picker and you think about commentary, they're all writing about just volatility and how that's a good thing. If you're a stock picker and you see volatility and you see markets selling off, I think there are probably a lot of people that are, what happened with DeepSeek the other day, there were stocks that sold off for 10% for no reason. Right, just because they were associated with AI. And so there are probably portfolio managers out there that went and bought and were excited about it. So sometimes volatility is a good thing. It tends to be more exciting for those that are involved in alternative investments, so we do have a small exposure.
Have time for more questions if there's others. I'd like to just say that the Catholic Legacy Growth portfolio is where all of the endowment funds are, except for the Conrad's Family Education Fund. So an endowment by its nature is a perpetual fund. So that fund is a long-term investment strategy, and that can handle more risk because it's there for the long term. The Income with Growth Fund is mostly the Conrad's Family Education Fund because that was a fund that was started with an old trust that had a requirement that the spending policy be income only. So that's why that strategy is designed around that. That fund provides grants to all of our Catholic schools every fall. They get a grant from that automatically. And then in the spring, we use the money from that fund to be part of our Catholic Community Grants program for the Catholic schools. So it's our largest fund. When we received it, it was $7.6 million in 2010, and I think it's about 13-something million now, and we've given away $3 million out of it since then. So that's been a good strategy for us. If someone puts a donor advised fund with us, they get to choose any of the 3 strategies that they might want to put their fund in. That's why we have 3 different ones. And like Michael mentioned, the third one has a focus on our charitable gift annuities, but we also have some people put their donor advised funds there.
Thank you.
I am not Del Ross. thank you, Michael. It was a great presentation, as always. We truly appreciate it. I know a lot of you in the room, but for those of you who don't know me, my name is Brent Herrin, and I currently serve as the chair of the board of the directors for the Catholic Foundation. Prior to introducing our next speaker, I wanted to share a few words with you about my involvement with the foundation and its impact on our community. I first became aware of the foundation due to a meeting that Nancy Coveny presented to the board of directors of the St. Thomas More Society, which I served on at the time and still do. I didn't, after that meeting, I didn't really give much more thought about the foundation or anything until a few years later. But the goals and missions of the foundation from that presentation had intrigued me. A few years later, my family and I established an endowment fund through the foundation in memory of our infant son that benefits Queen of Angels Catholic School in Roswell, where our other children had attended school, and one still does. We created that fund in 2016. And from that time, I wanted to become more involved in the foundation. I wanted to learn more about it. What does it do? Some of the stuff we've talked about today. And so I started talking with Nancy, and at one point in 2019, she asked me to join the board of the directors of the foundation. Since that time, I have come to see the amazing work and professionalism of the staff of the foundation and how they help our local community to be the hands and feet of Christ in helping others. As of December 31st, 2024, the foundation had over $138 million in assets. Last year, we had an overall earnings of 12%, and last year we gave grants of over $4 million to our community. Since the existence of the foundation, our local community has received over $34 million in grants. The foundation is governed by an independent board of directors with multiple committees that really do the hard work. Our investment committee works with Michael and his firm to make sure that our investments are sound and responsibly invested. Our finance committee works to make sure that we operate within our budget and that our annual audit and IRS Form 990 are completed without issues and on time. Our grants committee spends countless hours poring over grant applications to make recommendations to the board for grants during each grant cycle. And our development and communications committee work really hard to keep us known and top of mind within the Catholic community of the Archdiocese of Atlanta. I believe that we're a good team, and we welcome the opportunity for those of you that are here today to work with you directly, or for those of you that might be professional advisors to work with your clients to help leave a lasting Catholic legacy. Now on to why we are all here. It is my pleasure to introduce to you Tony Crescenzi. Tony is the Executive Vice President, Market Strategist, and Generalist Portfolio Manager in the New York office for PIMCO Investments. The foundation is invested in 2 PIMCO funds. Tony's also an advisory member of the investment committee for his firm. Prior to joining PIMCO in 2009, he was the Chief Bond Market Strategist at Miller Tabak and worked for both Lehman Brothers and Prudential Bash. He has written 6 books, including The Strategic Bond Investor and Beyond the Keynesian Endpoint. And he regularly appears on CNBC and Bloomberg Television and in other financial news media. Mr. Crescenzi taught in the Executive MBA program at Baruch College from 1999 to 2009. He has 41 years of investment experience and holds an MBA from St. John's University and an undergraduate degree from the City University of New York. Welcome to Atlanta, Tony, and please join me in welcoming him to the stage.
Thank you, Brent, and great to be with all of you. I'm reminded of a visit to a client a number of years ago in Nebraska. You might know it, the Boys Town. I remember speaking there and seeing the picture of Father Flanagan, if you know who he is. I'm older, so I sort of remember. There's a movie, 1937 or 38, with Spencer Tracy about the Boys Town, and so I was reminded of the importance of the work that we do at PIMCO and that all of you are interested in, of course, in the sense that everything we do affects people, the lives of many people. There's an article today in the Financial Times by PIMCO's founder, Bill Gross, who speaks to this. He says one of the key lessons of his career is that it's not all about raising assets, outperforming competitors, and such. It's really, in the end, affecting people. And he said it could affect the work that we do as investment managers in the whole community, hundreds of millions of people, if not billions of people. So that, in the end, is the importance of the work that we do, and I never forget it. It's a lesson I've learned a long time ago from Bill and by visiting clients such as yourself. So it's a great honor to be here because I know that everything that you do is extremely impactful on people's lives. It's not just about numbers. But we're going to talk a little bit about numbers because we have to. It's part of the equation, isn't it? I'm not going to use slides. I'm going to be talkative. We've got about 20 or so minutes, and then we'll talk together about things. I want to first talk about things that are worrying people with regards to the incoming administration in terms of economics. And I heard the questions about tariffs earlier. PIMCO itself is worried about this sort of thing. It released an article in the last few weeks that speaks to its one-year outlook. We call it a cyclical outlook. It's available on our website. It's called Uncertainty is Certain. I battled people internally about that title as a resident optimist. I said, if anything, there's more certainty about things that really matter to businesses and therefore to equity investors, to investors in credit instruments, to private equity, private credit, real estate, et cetera. There's more certainty on things that matter, including, for example, taxation. I think any business owner today could say confidently that they should believe that the tax rate is likely to stay where it is. So the corporate tax rate today is 21%, down from the mid-30s in 2017. It's highly likely that level stays. If anything, it might go down. I heard from an advisor, Josh Bolton, former White House Chief of Staff of George Bush, advisor to PIMCO in our global advisory board. He said his group, part of the Business Roundtable, a collection of CEOs of major companies such as J.P. Morgan, Jamie Dimon, for example. They met with Trump last summer, and Trump spoke to the idea of taxes, and he said he didn't like the 21% tax rate because it's not a round number, that he'd rather see it lower. He said, so why not 20? Why not 15? But it's not likely to go up to a different round number, 25. If anything, it'll go down. So that's a good thing. Businesses feel more confident about that sort of thing. Secondly, there's more confidence or certainty about regulations. It's a very difficult thing to measure in terms of impact, but the regulatory climate matters to businesses. They want fewer of those. Some regulations are good, of course. It can affect communities and such, but some regulations get in the way of businesses doing what they do. I'll give you an example of how you can gauge the regulatory climate by referring you to a book. You can Google this. It's called the National Register. Federal Register, sorry. It has every rule and regulation of the federal government and all its agencies, and there's a large page count. In 2015, before Trump took office, it was at 96,000 pages. When the first year of his term, it was at 60,000 pages. So he took out a lot of regulations. It's back up. We don't have the final count for last year, but it looks like after a flurry of regulations at the end of 24, the number's probably a little over 100,000 pages. So you should expect that to plummet next year. Again, just as a gauge, a microcosm of the story on regulations, which is a good thing for businesses. So when you worry about tariffs, you worry about price increases. But if there's a lower tax rate, that encourages investments. More investments, think of Ronald Reagan's supply-side economics theories. You can agree or disagree with this, but generally speaking, more investments tend to be good for creating more things and more productively to keep costs down. So thinking holistically about the story, the supply-side stuff on taxation, encouraging investments, can be an offset. It's an important offset. And again, regulatory costs add to the costs we pay as consumers for things, and so that's probably a good thing. So that's one angle, to think more holistically about the tariff story. There's more to this tariff story. For one, it's a one-time influence. So let's say the U.S. imposes another 10% price increase on China's goods we import from China. It's one time. There won't be another 10%, we think, in 2026, unless, of course, there's a series of additional tariff increases, but that's not expected. It occurs one time. Now, Ben Bernanke, the former Fed chair who heads our Global Advisory Board, he says what the Federal Reserve will do in terms of interest rates is look past that one-time increase, because tariffs can only have a short-term effect. The only long-term effect on inflation in the end is from Federal Reserve policy or from fiscal policy. We saw this in action, of course, in 2022 when both combined to produce a lot of inflation because we borrowed a lot of money as a nation, and the Federal Reserve helped support that by buying lots of bonds. It fed the beast, if you will, the inflation beast. But tariffs do nothing of the kind. It's all relative price change. One thing goes up, perhaps another thing will go down or will be lower, and we'll switch into those products. And as a bond investor, you should say, I don't care. Because if the consumer price index increases 1 percentage point next year, which is a dubious assumption because Donald Trump ran in part on the idea that inflation was too high, and the last thing he wants is a higher inflation rate. If the consumer price index increases a percentage point next year, let's say you own a bond fund that yields 6%, which is a common number these days, 0.1% per year over 10 years, let's say the average maturity is 10 years, it's nothing. You're getting 6%, so you lost 1/10 more per year from a higher inflation rate. And importantly, yields have gone up recently, and you've been compensated because yields went up in part recently, about 3/4 of a point on the idea that tariffs might lead to more inflation. So you've been more than compensated, so you shouldn't worry about it. Another way to downplay tariffs is to think about 2018 when there were tariffs put in place. We already have experience on this. What good did it do to worry about tariffs then as an equity investor? The S&P 500 since then is up 250%. The NASDAQ 300%. The markets basically ignored it, and we should expect more of that. And finally, there's probably a bit of a Hall of Mirrors effect that I'd say you should be thinking about. Hall of Mirrors in Versailles, France, a hallway, of course. A Hall of Mirrors in the sense that the Trump administration will be looking at markets in the same way that markets will be looking at the Trump administration for guidance as to what should happen next. So for example, what if tariffs have a terrible impact on the bond market? Yields shoot up, stock market plummets. You'd think then the administration will say, especially Donald Trump, what's happening here? Why is the stock market plummeting? Well, it's because of the policies you just announced, Mr. President. And so you could bet, knowing the behavior of Donald Trump, that he'll say, well, I don't like falling stock market, so maybe say something different and do something different. And so in a sense, the bond market, the stock market, will have influence on the administration, just as the other way around, a bit of a Hall of Mirrors. So in that sense, any move in markets related to tariff policy can be self-stabilizing. So I'm not going to worry so much about it. So that's kind of the view on tariffs. We can talk more about it in the Q&A if perhaps you disagree. There's another angle on the Trump policies that not only just Trump policies, but in general government policies that relate to government debt, because we've got lots of it. The government debt to GDP ratios reached about 100%. We're back to World War II levels, and there doesn't seem to be a way out. The government deficit will be 5 to 7% per year the next 5 years, according to the Congressional Budget Office, which is nonpartisan. It doesn't seem like there's any solution on the horizon. I wrote a book 10 years ago, Brent mentioned it, it's called Beyond the Keynesian Endpoint, the idea that there's a limit to the use of government debt. Keynes, of course, during the Depression said, when you have a problem, spend money. And we did a lot of that during the pandemic, and it led to higher inflation. But there's limits to that. We saw it in Europe 10 years ago when it had a debt crisis and Greece ran out of money. It couldn't borrow from markets anymore, so it put itself in austerity. And it's been in the midst of austerity ever since, and its yields have been lower than other nations in Europe recently because it's been disciplined. In the United Kingdom, two and a half years ago, Prime Minister Truss attempted to challenge the bond market by saying she'd raise indebtedness more, therefore causing more bond issuance. She said, I want to cut taxes, but I'm not going to offset those tax cuts with anything. I want to raise indebtedness. Bond market pushed back and said, no, you're not. The 10-year government bond in the UK went up 150 basis points in a few weeks, which is dramatic for a developed country. She got ousted, and ever since, the UK has been in the midst of austerity. It reached a Keynesian endpoint. In recent weeks, UK bond yields rose on the idea that the fiscal story had deteriorated. And the government responded. Rachel Reeves, the Chancellor of the Exchequer, basically the Treasury Secretary, she responded to the move in yields and said, don't worry, we're going to be careful about our finances. It's another way of showing that the bond market had significant influence on policymakers, a hall of mirrors, if you will. The U.S. hasn't really reached that point where the policymaker had to make a decision. But I would offer the idea that we're going to have, and this reflects my years in the industry, I guess, a lot of read my lips moments ahead. Read my lips for George Bush, 1988, at the convention in a speech written by Peggy Noonan, who, of course, is famous for writing speeches for Ronald Reagan. She said the biggest takeaway from the convention is when George Bush said, read my lips, no new taxes, because people remembered high taxation levels of the 1970s. But 2 years later, he raised taxes, and it hurt him. You could say, many historians will argue, because it's anathema to the party to raise taxes to the Republican Party. But he did it because interest payments as a percent of GDP were getting awfully high, and there's a lot of discussion about the debt, all the borrowing from the 80s to pay for defense spending, and he eventually lost, of course. 3.2% of GDP for interest payments. We haven't seen a number since, but this year we reached that level, and it moves up to 4% by the end of this decade. We'll have $1 trillion this year, roughly, in interest payments, more than the $800 billion or so in defense spending. So the public will maybe start to look at it again. In the early 80s, you had to have, in the early 90s and late 80s, you had to have a view on the deficit as a politician to be credible. Used to hear lots of talk about it from politicians. Today you hear none of it. But I think there'll be these moments, read my lips moments ahead, especially if the government tries to challenge the bond market and say, we're going to issue more debt because we want more tax cuts or we want to spend more. And this is probably the reason for the creation of DOGE, the Department of Government Efficiency, the two-person department. Now one, actually. It's shrunk already. Because they want to find ways to avoid these problems, because you can't raise indebtedness these days without the bond market having a say in it. So we want to be careful about what's ahead, but so if there are tax cut proposals, and we're expecting some of them, maybe $1.5 trillion, same number as 2017, as long as it's not larger and deficit spending is not larger, deficits don't grow, markets probably could be stable. But any attempt, again, to go bigger on tax cuts, bigger on spending, probably will face resistance and cause volatility in markets. The way to position for that is to be careful about long-dated bonds, because those would fall most, and they have the most interest rate sensitivity. So we'd rather be in the middle part of the so-called yield curve, having a 5-year maturity, 6, 7, somewhere in that zone, especially to lock in today's what we think are attractive yields. Most bond funds are yielding 5 to 7%, and that's the best we've seen in a long time. It's very good relative to history. It's doubled last decade. It's a lot more than the 3.25% average of the past 20 years and 4.5% average of the past 30 years. You'd have to go back up to a 40-year average to get a better number. And so it's pretty attractive. It's also attractive relative to expected inflation. I'm going to talk about inflation more in a second. expected inflation somewhere in the mid-2s or so. You could have doubts about that, which we'll go over, but mid-2s with a yields between 5 and 7, pretty good real rate of return. And then finally, yields are attractive relative to expected interest rate volatility. Major bond indices that have 6-year average maturities, the things that many have benchmarked against, sort of like the S&P 500 of bonds, they have yields of about 6, but volatility tends to be around 3 or so. So that's that risk-adjusted return, 6 divided by 3 is really good. Equities, which we favor, we think they'll do well this year, double-digit earnings growth, which drives returns in the end. They have volatility in the teens. So let's say it's a 7% expected return divided by 17%. Not as good as the bond market right now in terms of the risk-adjusted return. A better return prospect, probably long-term, of course, but in terms of risk-adjusted, today you're looking at fixed income providing pretty good juice. And the thing that keeps me up at night is not locking in. So I wouldn't want to be playing the T-bill game forever. I wrote a book on the money market, so I have a liking for the money market because this book was 1,200 pages. It was the first, in 2007, I was 43, and so it was the first year I started drinking coffee because I realized the power of caffeine to get through things. So I love the money market, but I don't want to marry it in a sense that I want to ensure that I lock in today's yields. And the starting yield is the determinant of future returns. If I tell you a fund or a bond has a 6% yield, of course, if you hold to maturity, that's going to be your return. But on a 5-year rolling basis, the starting yield of major funds will be the determinant of the return for that 5-year period. So I could say pretty confidently, based on history going back to the 70s, with 90-somewhat% confidence that you'll get a 6% type return in fixed income in that zone. Again, 5 to 7%, depending on types of risks you take, and that looks pretty good to us. So I'm going to talk finally about inflation and the Fed and where yields should be. And now on inflation, the nagging problem, of course, I'm going to argue that price stability has been achieved. We're still worried about inflation, we all are, but price stability from an investor perspective has been achieved in the sense that there's an old way to define price stability, defined by Fed chairs Alan Greenspan and Paul Volcker, who preceded Ben Bernanke. Ben Bernanke in 2012 implemented a price target of 2%. We didn't have a figure before 2012 to go on. If you were an investor, you had to go on a notion. Are prices stable or not? And this notion defined by those chairs, and you could Google it, they said almost the exact same thing. Price stability occurs when price changes, inflation rates, cease to have influence on household and business decision-making. That was the case last year with a strongly performing economy, near 3% growth, and a stock market that for a second year rose over 20%. In other words, investors and business owners and households said, I don't really care about the inflation rate. I care, I'm anxious about it, but it's not getting in the way of my decisions. And so an inflation rate that's 2.3, 2.4, 2.6, 2.5, as long as it's in that zone, it's good enough. We don't have to have a 2% inflation rate for the markets to be confident. And I could, if I had charts, one chart I'd show you is some proof of this, that whenever the inflation rate, going back decades, is 2.5 or lower, the inverse connection between bonds and stocks exists, meaning when stock prices fall, bond prices rise. 2.5% or lower. When inflation's higher, as we saw in 2022, everything falls. The fancy way of describing that is correlations are all one. Everything moves in the same direction. You want, of course, in a balanced portfolio, such as ACG gives you, you want some balance between the equity risks and some stability in the other assets. And that's what you get today, because prices are stable. Now, some of you might be arguing, well, I think the inflation rate's going back up, let's say to 3% or more. That's a way, in other words, a way of saying, I'm going to fight the Fed. The adage historically that benefits you most is don't fight the Fed. Ben Bernanke, in discussions with him, we talk to him every 6 weeks in our investment committee that I've been part of for 12 years. He's adamant the Fed will resist another acceleration in the inflation rate. If it got to 3%, it would do something about that. So it's highly probable the inflation rate will be stable. They won't do, the Fed, what they did in 2022 by supporting the fiscal authorities with easy monetary policy to provide the money for that borrowing. It'll be careful. It doesn't want a higher inflation rate. And so you should be confident about an inflation rate that's somewhere in the 2s from here, because that's where it is now. And that's a good thing, again, for households, businesses, the equity market and the credit markets and other assets. I'm going to end with the interest rates story. It's a way to value where interest rates should be by taking 3 parts. A bond investor always wants some compensation for the inflation rate. So I'm thinking of a 10-year treasury. The inflation rate I suggested to you to use is 2.5%, which is a reasonable number to use in the bond math equation, because 2% maybe is unreasonable these days. The Fed targets 2. So I just said don't fight the Fed, but I am in a sense, because it might be tough to get there. As you know, there's the energy transition, the rewiring of the global supply chain, more defense spending, many other things that are keeping the inflation rate higher. Probably will for a little while. So 2.5 is pretty reasonable to use. It could even be lower, but I wouldn't use a much higher number when trying to decide what's the right yield, what kind of yield is attractive. 2.5 for that. And then there's something called the term premium. It's the extra yield the bond investor says they want for risks associated with stepping out of T-bills. In the UK 2 years ago, it was something more because they didn't like what government was doing. So that's going to be affected by fiscal policy, but as I suggested, the whole of mirrors will keep that under wraps. Historically, a term premium, extra yield of a point or so, is pretty reasonable to expect. But again, there's potential for volatility, so we'll watch out for it, but I'm not too worried. So that's 3.5, 2.5, 3.5 perhaps for prospective range. The term premium, by the way, the last 7 years has been negative. Investors said, I don't need extra yield, I just want safety of bonds. Finally, it's this thing called the neutral rate. It's a little complex to talk about, but suffice it to say, where is it that the policy rate from the Fed, which is today 4.25, is neutral? And it's described typically as an amount over the inflation target. The Fed thinks the neutral policy rate is 1 point over the inflation target, or 3%. So we use 1 point for that component. But it can be lower, it can be a little higher, but not much higher. So that's about a 2.5, 4.5% type prospective range. You could argue some of these things should be a little higher, as I said, fiscal, inflation, but not a lot, so maybe 5. Maybe 5. But yields have been in that zone recently. We're at the top end of the yield range, which is why PIMCO has been overweighting its interest rate sensitivity, having a little longer maturities, half of a year to 3/4 of a year over versus a 6-year type index. And so we're pretty confident, and I don't want to miss out on what's the markets are offering us today. All right, I'm going to stop there because you might have questions. And but again, I'm just excited about the rise in yield lately because we've had an increase of almost a percentage point. It's a second bite at the apple. I was worried that many had missed it. I love getting the checks. You all love getting the checks these days. Seems like free money for your investments. And the last thing I want to see is that fade. I'm sort of banking on it for my own future, so I'm trying to lock in. I'm 61. I got to start thinking about increasingly about that. All right, happy to take questions and or comments if you have any, and certainly welcome counterpoints. Yes, sir.
I'm confused. Over the last month, my bills just continue to go up. My Microsoft Office went up 30% this year. My Netflix went up 13%. My question really is that already baked in somewhere into the inflationary numbers, or are we getting ready to see another kind of wave of these higher, particularly on subscription-based things?
Well, you're part of the reason why the inflation expectation figure in the widely watched University of Michigan Consumer Sentiment Survey went up the past month. People have heard the news on tariffs, thinking about the inflation story of the last few years, and have been affected by it. New generations of people have been affected by it. I'm a boomer, and the last boomer, so to speak, born 64. I know about inflation. Now, the youngest, Gens Y, X, Y, and Z, have seen inflation for the first time. And so it's affecting Netflix and others and raising prices. By the way, when Netflix changed password sharing, I was sharing it with many, many people. And but the family, they all make me pay. They all think I have endless amounts of money, so they asked me to buy them new subscriptions. I bought the stocks, and it's been a winner. So that was one way to offset it. I did the same for Apple years ago. That's been a winner. But I think the inflation expectations, they really matter. How you feel about it matters. I remember having dinner with Janet Yellen, former Fed chair and Treasury Secretary. She visited us in Newport Beach, and she was talking about inflation, and I referred to 2 papers she wrote on inflation dynamics in 2015 and 2017. In those papers, she's very thorough. 40 footnotes. She said the main driver of inflation is how people feel about it. So you can talk about many, many, many things, tariffs, et cetera, but that all feeds into how people feel. So if you're feeling that way, and you think many others are, it can affect inflation. So in that sense, it can keep going a little bit. But that's why the Federal Reserve is pulling back. The markets have signaled that the Fed will cut rates less than it previously thought, a percentage point less this year. So the policy rate was supposed to drop to 3 or under, 2 3/4 by the end of this year, according to previous expectations. So 4 1/4, the key in the end is that high enough to get that Netflix and others from raising prices? Is it enough to keep putting downward pressure on inflation? Chair Powell said yesterday it is. That's very restrictive because the Fed thinks the restrictive rate's anything above 3%. So it's currently 4 1/4. Where's the proof? In the job market, in the end. Because the job market has seen a significant deceleration, still strong, but job growth's about 150,000 people a month. It was 250 plus. It's been slowly decelerating. And the reason it'll decelerate more, 2 reasons. One is immigration flows are slowing, and some people think more than half of job growth last year was from immigration, filling jobs that were open. You won't have that as much, and that'll slow things down, and then slow incomes down. And secondly, this simple inflation math that I know Ben Bernanke and many economists use. It's simply to take the wage figure year over year, subtract productivity, and that's the inflation forecast. Wages today are 4% in the United States year over year. The productivity is 1.5%, arguably higher now because AI and other things, productivity seems to be rising in the past few years to 2%. So that means the inflation forecast should be around 2.5 or lower. So productivity is one of the key arguments, that plus the job market, whether it slows. And it looks like we're on track for that. And difficult to argue otherwise. The final word is job openings were 12 million in the U.S. at one point. Now they're 8 million. So there isn't as much demand for jobs, and that should bring the wage figure down and therefore the inflation figure. But as I said, it's in people's heads still. It takes a long time to get out, especially with new generations of people having experienced it. And that's why they've really got to, final word is keep at it. Chair Powell said a few years ago, 3 lessons of history. 1, take responsibility for it. Secondly, pay attention to how people feel about it. And he said, keep at it, quoting Volcker, who Bernanke has told us is Powell's hero. Keep at it is from Volcker, 2018, wrote a book called Keeping at It. So he really wants to leave that as his legacy when he leaves in May 2026. And so I'm going to have confidence in the institution and that there is slowly this rebalancing of the job market to enable disinflation to get it out of people's heads. So, but but highly respectful of how people feel, like yourself. Yes, sir.
Quick question, if you would just wax philosophical with me, mass deportation of illegal immigrants and then the efficiency program with presidential's campaign to lay people off the government, effect on the unemployment rate and then the macro economy that results out.
Thank you, sir. So the questions about the deportations and that sort of thing and DOGE impact on the macro story. So I mentioned one major impact will probably be on job creation and therefore income growth and therefore inflation and therefore interest rates all lower. And so that seems a likely story. The deportation stories, and I'm not looking to downplay it, 'cause there's a lot of dramatic and sometimes scary things in that regard. But I've looked at deportation statistics through the various administrations, and we've had large numbers in the past. And I was shocked when I looked under Democratic and Republican administrations. So it's in some ways nothing different. Perhaps the means at which they're going about it is a little different. We see the battle with Colombia, for example, that was different. Guantanamo in the discussion is different. So, but if it's a few planes, and I care about the people in those planes, of course, but it's trivial in the macro perspective because it's just a few hundred or hundreds of people, a few thousand people, tiny for a giant U.S. economy. So I think the economic effect is not going to be as large as you think because we've had deportations in the past, or simply hadn't had them in recent years. But it's going to have a negative impact on, again, job growth, income growth, that lowers the inflation rate. In the end, therefore, probably leads to somewhat lower interest rates, would be the wager. And the cost cutting, we estimate, will be about $100 billion per year will be the result. They're looking to get more out of it, the group involved, I should say person involved, and but it looks like 100's all you can get because you can't really cut the big things like Medicare, Medicaid, Social Security, and it'll be enough for markets in a sense that looked at over 10 years, it's $1 trillion, and if there's a tax cut for $1.5 trillion, then at least there's something there to help pay for it. Then there'll be other things that they find to probably fix, to balance it all. With leaving financial markets relatively imbalanced, because financial markets then will think about the economic impact, which will be relatively neutral, because if a spending cut of $100 billion could be offset by tax cut of $100 billion, and therefore the macro impact is neutral. They're trying to be careful about negative impacts because Trump wants a strong economy, and so the thing I would worry in the end is that they feel that spending cuts and deportations having too deleterious an impact and try to ramp up tax cuts and do things like that, or more spending. That leads the bond market to get worried, and then you have a negative macro impact. So in the end, the Hall of Mirrors thing is going to be really important that markets get respected about their opinion about what's prudent. But I think, again, that they will be prudent. Final word on that is that the Treasury Secretary, Scott Bessent, is a markets guy and who has sensitivity to markets, will be watching markets very closely. In the same way that one of my favorite Treasury secretaries, Robert Rubin, did. Late 90s with Bill Clinton, they solved the deficit problem. They followed George Bush's lead in a sense and kept going. Had constructed a very good set of policies that led to 4 years of budget surpluses. Robert Rubin from Goldman Sachs, highly sensitive to markets. He wanted to harness the power of markets, if anything. Remember James Carville, of course, he said he wanted to be reincarnated as a bond investor because you can scare everyone. He used to say it, and that was in the 90s. So I think we'll have Bessent be like that because he's really a markets guy for sure. So that's a good thing. Any other questions? Yes, sir.
Do you think you can still have the same measure of accuracy in your models about the labor market before and after the pandemic? Didn't something really change in terms of the cost of labor, and the attitudes of people towards work?
Really great question, because it's one of my favorite areas to think about, because I think it has. So on the eve of the pandemic, in Davos, the annual economic forum, and you could look it up, they delivered the so-called Davos Manifesto, saying that the new model for shareholders is stakeholder capitalism, not the shareholder capitalism model of Milton Friedman, who in 1970 wrote an essay in that regard, where he said the sole purpose of a company is to grow its profits. Any social responsibility is on you, the households. Businesses, it's not our problem. But it's changed. Every business today has to seem to be caring for the community, the climate, and people. And so that really changes the labor dynamic. They can't treat workers the same way. There has to be a little more inclusion, diversity, and sharing the income a little bit more, allowing more flexibility with hours, being out of the office, et cetera. It has changed. And so that probably means a wage figure, in terms of markets and macro, a wage figure of 3.5% for, instead of 2.5%, 3%, like last decade. 2.5%, 3% is what led to the 1.5% inflation rate, using that math equation I mentioned. So 3.5%, 4%, which probably means, therefore, an inflation rate that's a little higher than last decade, because people need to be treated better, share some of that high income that companies have today relative to GDP, record high. So I could see that. That's a great thing to be thinking about. So that's the path to increasing shareholder values through the stakeholder now. Can't just think about the shareholder capitalism model and care only about profits. It's different. You get there a different way. All right, I think I'm running out of time, but, right? Any more questions? Or another question or two, if you like? Yes, ma'am.
Can you describe what the impact of energy prices will be on our economy?
Impact of energy prices on the economy. We don't think there'll be meaningful decrease in price. The drill is only applicable when prices are high, because then those who do the drilling have an incentive to drill. So there isn't, the cost of producing oil hasn't decreased enough for them to say, at today it's 70 somewhat dollars a barrel, that we want to drill lots. There were lessons learned in the 2010s. There was too much drilling, and many companies went out of business when prices plummeted, and that they've been very careful about using their capital, in deploying the capital to invest in new drilling. But if anything, you could probably say there's a cap on prices. So you may not get a plummet, but certainly a cap on it. And that's a neutral thing, and in the end, the consumers will make decisions, like I did. Because my daughter was living in the basement with her new husband, still are. She's 30. It's okay, but they both have Teslas. It's my fault. I bought her a Tesla. I have a Tesla because I've had one since 2016. And they don't charge outside of the house. And New York, the kilowatt price is double, 30 cents, than other places. And it's getting killed. So I bought a solar roof to try to solve the problem. So consumers will make decisions to help to reduce energy costs, because I'm not buying any more oil. But there'll be fewer incentives, though, for that. I did it in part because it was the government regulations, incentives, 30% cut in the price that the administration is looking to stop. So I worry about that a little bit in terms of the energy transition, and therefore I might be buying more oil, or others will, because they won't have the incentive to buy a solar roof, to buy an electric car. It might slow it, and therefore that's another reason to think the price won't go lower, because the incentives are going to drop a little bit. But there will be more and more of this, because there are going to be more and more kids who live in basements. It happens. You can't help it. Yes, ma'am.
So I know that there was this push in the Biden administration to have ships manufactured in the country. And they didn't know how that was going on right now with the tariffs. But I mean, is that going to still be going on? Is there a big incentive to this push to build manufacturing?
So regarding manufacturing and chips as an example, will there be this continued push? And we think so. And I'll quote Josh Bolton again, the head of the Business Roundtable. These giant companies are part of his group. And they're not abandoning China, as he says. They all have a China Plus strategy. They're trying to rewire the supply chains to not depend on China. And that means bringing more here. And they're also being careful about bringing production to Mexico and Canada, because you see the obvious target that's on them. I was in Mexico not too long ago, and they were very worried about that, especially the automobile sector, because many think that some production from China is occurring through Mexico and many different things, not just autos. So I think there'll be more and more of that because they all want to be careful, stay neutral, geopolitically neutral to the extent they can. Stay a little bit invested, a little bit of a foot in China, but it's too risky to have both feet there. So we'll see more and more of this, but it's more costly here. So that's another reason I think the inflation rate won't easily get to 2, the rewiring the global supply chain. But there will be more and more China Plus strategies and more diversity. That's another reason when you think about investing, and ACG does this greatly, and having lots of things in lots of places is a way to diversify the portfolio because you're going to have lots of these winners and losers, and you got to balance it out because you can't really get it right. You don't want to put all the eggs in one basket in terms of a region or a sector. So it's a good lesson. Yes, sir.
As bad as the U.S. bond market did in 2023, a lot of these international markets in bonds were just as bad or worse. Are you seeing any opportunity globally, geographically?
So regarding the bond markets, right, in 2023, 2022, you can have different performance in different parts of the world. And so how are we thinking about international bond investing today? We find it a very attractive, target-rich climate for investing in international fixed income. It's a $150 trillion market, and economies move at different speeds. Whereas in the 2010s, most yields were all near 0 or 1%. Today, they vary, and the speed at which central banks are moving varies. Today, the European Central Bank lowered its policy rate. Yesterday, the Federal Reserve did not. The European Central Bank is hinting it'll do more. The Fed is not. So we have a little more of our interest rate sensitivity in Europe than previously. Secondly, in the UK, lots of Europe. Struggle when I say Europe and then I say the UK, isn't it? Part of it, like they try to be anti-Europe, but they're still part of Europe. We have an overweight to UK bonds because their yields are pretty high and we think their economic story is not good. Also on China, there's a lot of worries about its economy, shrinking population. By the way, the population, some people think, will shrink to 800 million by the end of the century. It's that swift. There's nothing on the horizon to suggest any change for 25, 30 years. That's an interesting thing. But anyway, their economy has some dynamics like that, shrinking population, that make it negative. And their export growth is weak because of the world saying no a little bit more. The way to play that is through Australia because they have a connection to it. So we are long Australian fixed income. And plus, in Australia, they don't have, like us, locking in at low interest rates for mortgages. Most had adjustable mortgages, and they're getting hammered. The household sector's in bad shape, and so we think that bond market's target-rich, something to target. And then also there's other areas. So we're careful about credit exposures because the credit spreads, yields over treasuries are tight, very close to treasuries, too close for our comfort. So we look for other sources. And that could include, for example, we bought Mexican debt denominated in dollars a few weeks ago, had multi-billion-dollar offerings. We bought a chunk. For a 12-year maturity, you were able to get 3 percentage points more than U.S. Treasuries. We consider it a triple-B credit. Triple-B bonds, historically, according to Moody's, have a 0.1% default rate, meaning 99.9% chance of getting your money back. And so why not get 3 more points than Treasuries when other securities rated triple-B companies are 1 point more? So that was an international example. Final example, Saudi Arabia, Kingdom of Saudi Arabia issued single A rated, 99.9 something percent chance of you getting your money back. Seems like they've got a lot of money, Saudi Arabia. 1 point more than Treasuries, which is astounding considering what companies give you over Treasuries, small. So there's lots of things like that. Peru, I can go on and on. So we're finding many, many things to do. Yes, sir. Michael.
No one else has asked, so I'll do it. Curious about AI, both at the PIMCO level, where people all starting to explore usage, then also the worker productivity level, how that goes through the general economy, given the potential productivity.
So questions on AI, how we're using it, and more broadly. I try to use it. I asked about AI about my bio. I said I worked at the New York Stock Exchange, which I never did. I So maybe I'm reflecting my age, a little skeptical to some extent, but I do find our analysts, our credit analysts, use it extensively. So when they're constantly following companies, of course, and they'll visit companies and listen to their calls, and they let AI do some of the work and find key words, key phrases. And so it's been really useful for credit research. So you could be careful about pitfalls and owning the wrong bonds that go to zero. You don't want any of that. So it's been really useful from a credit research standpoint for us, and many other ways that we're trying to do it. So for example, we want to create a chart package. Clearly it didn't work because I don't have I did have a packet here. I didn't even notice it. I don't tend to use my slides. But we have an AI tool that I could say, I want to show that yields are attractive. And it'll pull from every chart we have at PIMCO, thousands, and it'll show us them. So, but I find it flawed, so I didn't use my slides. But more broadly for the economy, it's difficult. People always say that you can't measure, you can't predict productivity. Like in 1995, there's a technology shock, all this stuff on the internet. Greenspan used to say it takes years to really know. And there's three sources of productivity, which is ultimately what determines the changes in standards of living. One source is us, human capital, education, skills. Secondly, stuff, AI chips, roads, bridges, et cetera. And third, the biggest component of productivity is TFP, total factor productivity, how we use people's skills and stuff to be more productive. It's the TFP part that we're all just learning, because I haven't learned, to use AI in better ways. This week was a development by a company in China that may enable more use and better adaptation, that it allows the productivity number to rise. So I think we're on that path already, like in the late 90s with the technology shock, with TFP, using what's there to be more productive. And we're all trying to figure it out. I know my car, my Tesla, careful about it. It does the self-driving thing. So I think is it good? I don't know. It doesn't let you use your phone, by the way, if you've tried this. If you're doing the self-driving, I'm really careful about when I use it. I'm still paying attention. There's a camera in the car, and it tells you, it knows that when you're on your phone, it tells you to stop. It's pretty interesting. So I like the AI stuff that's happening. So I think it's going to mean more productivity, good for in corporate profits, good for the equity markets. Not necessarily a great thing for bonds in a sense, not a bad thing for bonds. What I'm going to say is, when there's more productivity, there tends to be somewhat higher real interest rates. In the late 90s, there were budget surpluses under Clinton, but we had treasury yields, a 10-year yield between 5.5% and 6%. Today it's 4.5%. Because there was so much competition for money, it went toward these assets like AI equivalents, the dot-com stocks. It had somewhere else to go. And so that pushes up the demand for capital, competition for money. It goes there instead of bonds, and you get a little bit higher interest rates, and that's what we have now. It's not a bad thing, but just noting that that's one offshoot of it, even though it keeps the inflation rate low. It makes higher real interest rates, difference between the inflation rate and the yield. Yes, sir.
For debt to GDP, do you think that'll continue to go up over time? And are you concerned as a bond investor?
Yes and yes, because it'll go up over time because in the current story, because yields are more than, just suffice it to say, more than nominal GDP, which by definition means the debt will keep growing. So if your interest payments were higher than the income you were earning, you're going to have more and more debt over time because you can't keep up. So if we had credit cards and all this interest payments, and that's just the math of it. And so, and this is rare. We haven't had this because the nominal GDP, which is overall income, you could say, has gotten a little weaker. And that's part of the story in terms of the interest rate story I mentioned. That's probably going to get better. It does look like the Fed's interest rate is restrictive and will lead to more rebalancing of the job market. So that's a little bit of a problem. And we worry in the sense that I said that somehow the administration would decide to ignore the bond market, and at its peril, I would say. But you insulate yourself by having intermediate maturities that the long maturities will get hurt most because price changes move inversely with yields, and they move fastest with the long maturities. But we think that respect for the bond market will show up. It's an evolving story because there doesn't seem to be a George Bush in power or a Bill Clinton Rubin team yet. The national the nation isn't talking about debt enough, but it's starting to. You could see it in the questions I get. It's evolving. And I think in the next general election, you'll see more politicians talking about it. Nikki Haley was trying in talking about reforms of Medicare, Medicaid, in saying that in the out years, the very young might have to have a different expectation, not threatening any of us, so to speak. And that, I think, is entering the national dialogue. But so that it is something to be watching in the next election, because we've got to do something or it will keep getting worse and worse in that sense. All right, I think, yes, sir. Have we taken a position on cryptocurrency? Yeah, here's a yes and no. We were looking at it. We had a group that had 100-page PowerPoint presentation. And then we stopped. I haven't heard from them in several years. It's too volatile for PIMCO. We cherish the preservation of capital and avoiding significant volatility in our portfolios, and it's simply not for us. We could have done like others have and offered products that relate to it, but it doesn't fit in. It's not in our purview. But we have views on it, which is basically it's highly volatile, and it's as a currency. Imagine your dollars were volatile in terms of their purchasing power. That wouldn't be a good thing. So we're really careful about it and recognize it's a medium of exchange. Yes, you can use it, and I know the foundation accepts it, and of course it makes sense. And there are reasons to think it could keep rising in value, but it's volatile. So we really want to be very careful about it. So sorry I don't have a lot more to say. We'll want to watch the administration as it relates to the Federal Reserve, which can have a big say in this, and the next Fed chair, who might or might not be a crypto skeptic or backer and affect how money gets issued. It might become more electronic currency. But it doesn't, I always thought that we already had electronic currency with PayPal and Venmo and stuff, so I'd rather go with, I'm going with that. Footnote, I buy and sell crypto myself through PayPal based on market psychology. Just when it's zooming, I know it's time to sell. When it's falling, just because of the way the public's enamored, I'll buy it. I don't know nothing about it except that market psychology is easy to predict and understand. Yes, sir.
You see a lot of portfolio managers over allocating to high yield into 2025. The spreads are still pretty tight. What's your opinion there? Get a little more yield.
Questions about high yield bonds. Our view and how credits this yield spread to the less risky treasuries is really low. 2.5 points. In a recession, it's 8 points, and that's a lesson right there. So we're underweight. As an example, in my group, total return group, we have 1% of our money in high yield bonds, but when we're more confident, it's 5%. So, it's idiosyncratic. So for example, today, Quick Read, you might be familiar with the cement bags in Home Depot. It's making an acquisition, issuing bonds, and its bonds to us look attractive because it's a large issuance, and PIMCO has a lot of money and want to have large issuance to get in markets. And typically, Quick Read, when it buys other companies, tends to bring down its debt over time, improving the credit worthiness of its bonds. And so it's double B, which is junk, but we think someday it'll be triple B, which is not junk. And so it's idiosyncratic. And as I said, there's other things to do. Mexico has a yield that's more than the high yield market. And we think that the government of Mexico will pay us back. And these are dollar denominated, no currency risk. It's just other things to do, and that we need to step out and take that risk to get yields that look attractive to history, expected inflation, expected volatility. You simply don't need to go there right now. But not a bad place looking at the yield on the whole. It's still you're insulated to some extent by price changes. And final word on it is that the wall of debt maturities in high yield is 3 years out, meaning not many high yield bonds mature this year, so not many, by definition, can default because they don't have to pay you back this year. 3 years from now, different story. All right, I'll step off. I'm happy to talk to any of you afterward. Great to be here. As I said, it's a great honor. And just as when I walked out and saw Father Flanagan on the walls at Boys Town, I know that the work that we do has impact. The caring that you have has impact, and the investments you make, et cetera, greatly impactful on people. It's not just numbers. And great honor to be here. So thanks again. Thank you.
So the Catholic Foundation of North Georgia thanks you all so much for sharing your valuable time with us today. We hope you found the information very valuable. You know, it's super great. So thank you all. Later today, you'll receive a survey and an email, and your feedback is really important to us. As the plan giving partner and the chair-leading partner of the Archdiocese of Atlanta, we want to know if this content, if this information, if this gathering is valuable, is interesting, is great, for you all, and what other types of events or speakers or information would you like from our organization. So thank you for filling out those surveys. We'll also make the recordings available to you all early next week. The Catholic Foundation Professional Advisors Network brings together estate planning attorneys, accountants, wealth managers, insurance advisors to promote, collaborate, educate, and promote leadership with current and legacy giving among our Catholic clients. We invite you to partner with us. Please go to our website at cfnga.org to register to become a part of that professional advisors network, or call us. Call Nancy, call me, Lisa McLean in the back, or any of our staff members are happy to talk to you. A very special thank you to our presenters, to Deacon Andronaco, to Brent Herrin, Del Ross. We really appreciate your time with this event. And tremendous gratitude goes to our keynote speaker, Tony Crescenzi, and his team. Thank you so much. And of course to Michael Butkus with the Brand Consulting Group and his team as well. Thank you all for making today a special event. He's got some gifts to the charitable organizations that you care deeply about. As good stewards of our assets, we are grateful to our sponsors that help make this event possible for our community. Atlanta Consulting Group, Morris Legal and Tax, Network One, Samantha Hollico with Northwestern Mutual, Smith Howard, St. Thomas More Society, and the Quest Catholic Radio Station. Thank you so much for your sponsorship and your support in this event. So whether you're a professional advisor, an individual, and a parish, school, or nonprofit organization who wishes to make a lasting impact in our community, please call us. Please talk to us at the Catholic Foundation. We're here to serve each and every one of you. Everything we do is aligned with our Catholic faith, and we're so fortunate to do this important ministry. With you, God bless you, and have a good day.